Welcome to the deep dive. Today we're tackling something that can sound a bit complex, hedge accounting.
Mm-hmm.
Think of it as, well, a strategic choice companies make, adjusting the standard accounting rules when they're actively managing financial risks.
Yeah, things like currency swings, interest rate moves, that sort of thing.
Exactly. It's voluntary, a specific way to reflect their risk management efforts in the numbers.
Right. It's not about changing the rules willy-nilly, but applying a specific framework. And we see this under both IFRS 9 and US GAAP.
The two big ones.
Yeah, International Financial Reporting Standards and US Generally Accepted Accounting Principles. It lets companies account for their hedging instruments, derivatives usually, in a deliberate way.
And we've got some great material from Accounting BOTcast LLP guiding us through both IFRS 9 and US GAAP here. Our aim today isn't to make you a hedge accounting guru overnight.
Definitely not. It's complicated stuff.
But we want to pull out the core concepts. And maybe more interestingly, where these two frameworks, IFRS and GAAP, go different ways.
Yeah, the similarities are there, but the differences are often where the really interesting insights lie. Why they diverge.
Right. We want you to get a feel for those nuances. Because how they approach reflecting risk management can actually lead to different results on the financial statements.
Absolutely. So maybe let's start with the basics. What's hedge accounting actually trying to do?
Okay, yeah. Let's unpack that. The core purpose.
So at its heart, and this is true for both IFRS 9 and US GAAP, it's a choice. It's voluntary.
We really have to do it.
Exactly. And if you choose to apply it, you can measure certain things, assets, liabilities, even commitments in a specific way. And crucially, it lets you defer the gains or losses on your hedging derivatives.
Instead of them hitting profit and loss immediately.
Right. You match them up, essentially, with the financial impact of whatever risk you're hedging over time.
So it gives a clearer picture of how the hedge is actually offsetting the risk, not just, random derivative volatility hitting the income statement.
Precisely. It's about reflecting the economics of the risk management. And under both systems, IFRS and GAAP, you have three main types, three models.
Okay. What are those?
Fair value hedges, cash flow hedges, and net investment hedges.
Right. Fair value for changes in value of existing things,
Yeah.
cash flow for future cash uncertainties.
You got it. And net investment hedges are specifically for managing currency risk on your investments in foreign subs.
Okay. But you said the categories are the same, but the rules within them might differ?
That's the key point. The labels are similar, but the detailed requirements, they can diverge quite a bit.
Okay. That sets the stage. So what kind of things can a company actually hedge? What qualifies as a hedged item?
Well, there's a lot of overlap here. Both frameworks let you hedge things like assets and liabilities already on the balance sheet.
Okay. Recognize items.
Yep. Also, firm commitments, those binding agreements for the future, and expected future transactions.
Oh, the forecast transactions.
Exactly. Though IFRS calls them highly probable forecast transactions, while US GAAP uses probable.
Highly probable versus probable. Sounds like a subtle difference, but maybe it's not.
It can matter, yeah. We can scroll back to that. And finally, both cover net investments in foreign operations.
Got it. So, similar broad categories.
Yeah.
Where do they start to differ then on what counts as a hedged item?
One interesting one is something IFRS calls aggregated exposure.
Aggregated exposures.
Yeah, it's where you might say combine a non-derivative risk, like a forecast foreign sale, with a derivative, like a forward contract hedging it, and then treat that combined position as the thing you're hedging with another instrument.
So you net things out first.
Kind of. US GAAP generally doesn't permit that. They tend to want you to look at the non-derivative and the derivative separately.
Okay, so IFRS maybe allows a bit more of a portfolio view there, while US GAAP is more instrument by instrument. What does that mean practically?
Well, it could affect how you structure and document your hedges, maybe simpler under IFRS if you naturally manage risk on a net basis. US GAAP might need more granular documentation.
Right. Any other big differences on what you can hedge?
Yes, equity investments. This is a big one. Under US GAAP, you generally cannot designate an equity investment as the hedged item in a fair value or cash flow hedge.
Really? You just can't hedge them that way.
Pretty much, but IFRS does allow it in certain cases. Specifically for equity investments measured at fair value through other comprehensive income, or FVOCI.
Okay, so if you hold shares and account for them via OCI under IFRS, you might be able to hedge them, but not under US GAAP. That's quite a difference.
It is, and think about those firm commitments we mentioned earlier.
Like agreeing to buy something in the future.
Exactly. Say, a firm commitment to acquire a whole business. IFRS lets you hedge the foreign exchange risk involved in that commitment.
Makes sense if you're buying a foreign company.
But US GAAP doesn't consider that a qualifying hedged item.
Why not?
The view under US GAAP is generally that buying a business involves too many intertwined risks beyond just FX. It's hard to isolate just the currency risk effectively for hedge accounting purposes.
Okay, that logic tracks. You're buying more than just currency exposure. Now, what about the type of risk itself? What risks can you actually hedge against?
Generally, under both, the risk has to be one that could potentially affect profit or loss. That's the main link.
P&L impact.
Yeah. But IFRS has that exception. We just talked about the FVOCI equity investments. There, the hedged risk might affect OCI instead of P&L.
Right, because the investment itself goes through OCI.
Exactly. US GAAP doesn't really have that exception because, well, you usually can't hedge those equity investments under GAAP anyway.
Got it. So broad alignment on risks hitting P&L, but key exceptions mainly driven by what you're allowed to hedge in the first place. Okay, let's get more specific. Hedging components. Can you just hedge like a piece of an item?
Yes, definitely. Both IFRS and GAAP allow you to designate either the whole item or just a specific part, a component, as the hedged item.
But I sense a but coming.
You sense correctly. The types of components you can carve out, that's where they differ again. And US GAAP tends to be much more specific, often more restrictive.
Okay, examples. What kind of components?
Both talk about risk components. That's changes in value or cash flow due to a specific risk, like interest rate risk or currency risk, as long as you can identify and measure it reliably.
Makes sense.
You can also sometimes hedge selected contractual cash flows, maybe just the interest on a loan, not the principal, or a component of the nominal amount, like hedging the first $1 million of a $10 million bond.
Okay. Where's the US GAAP restriction then?
When you look at risk components within financial items, US GAAP lists specific risks you can hedge. Interest rate, FX, credit, overall fair value cash flows, price risk, or combinations.
A defined list.
Pretty much. IFRS is potentially broader in defining what could qualify as a separately identifiable risk component.
So maybe more flexibility under IFRS to define a specific risk component you want to hedge if you can reliably measure it.
Potentially, yes. And this specificity continues. Take interest rate risk in cash flow hedges. Under US GAAP, for variable rate debt, you can only hedge changes in the contractually specified interest rate.
Not just any market rate.
No. And if you're hedging a forecast deal involving fixed rate debt, you're generally limited under GAAP to hedging the benchmark interest rate component. IFRS is less prescriptive there.
Okay. What about non-financial things, like hedging part of a commodity contract?
Here again, US GAAP is often more restrictive. For non-financial items, excluding certain servicing rights, you can generally only hedge a component if it's contractually specified.
So it has to be explicitly mentioned in the contract, like
Yeah.
a fuel surcharge clause.
Exactly. If it's not spelled out contractually, you probably can't designate just that component under US GAAP. IFRS doesn't have that strict contractual specification requirement.
Interesting. And what about inflation risk, say on inflation-linked bonds?
Good question. US GAAP actually lacks specific guidance on hedging inflation risk components in those bonds. IFRS, however, explicitly acknowledges that a contractually specified inflation risk component could be eligible if it's identifiable and measurable.
So another area where IFRS gives more direct guidance, potentially making it easier to hedge that specific risk.
That's a reasonable interpretation. Now, both frameworks do allow partial term hedges.
Hedging for just part of the instrument's life.
Exactly. And you can designate a proportion like 75% of an asset, or something called a layer.
A layer, like the bottom slice or the top slice of value.
Kind of like that. Hedging, say, the first $5 million of losses on a $20 million portfolio. But again, US GAAP restricts this layer component concept mainly to the portfolio layer method and only for fair value hedges. IFRS applies the idea more broadly.
Okay. Always these little nuances.
And here's a really quirky one. US GAAP actually has an exception allowing the designated portion of cash flows or fair value being hedged to exceed the total cash flows of the item itself in some very specific cases.
Wait, you can hedge more than 100% of something under US GAAP? How does that work?
It's an exception, not the norm, and has specific conditions. But yeah, it's possible. IFRS doesn't allow that. The component must be a subset of the whole.
Fascinating. Okay, let's switch gears to forecast transactions. We mentioned highly probable versus probable. Does that difference bite?
It really can. While neither standard gives a hard number like 80% or 90%,
Right, no fixed threshold.
the general understanding is that highly probable under IFRS implies a much higher likelihood of the transaction happening than probable under US GAAP.
How much higher?
Some guidance suggests highly probable might be thought of as, say, 90% likely or more, whereas probable under US GAAP's general definition just means more likely than not, so over 50%.
Wow, okay. So a future deal that might be, say, 70% likely.
Could potentially qualify for cash flow hedging under US GAAP's probable test, but might fail IFRS's highly probable hurdle.
That could definitely lead to different hedging approaches or accounting outcomes just based on which standard you follow.
Absolutely. Now, what about hedging groups of items? Often more efficient to hedge a whole portfolio, right?
Makes sense. Can you do that under both?
Yes, both permit hedging groups if they meet certain criteria,
Yeah.
but here's a major split. Net positions. Under IFRS, if it fits your risk management strategy, you can hedge a net position, say your net exposure in euros, after netting receivables and payables.
That seems practical.
It often is. But US GAAP, generally no hedging of net positions allowed. You have to designate hedges against specific gross assets or liabilities within the group.
So again, IFRS seems more aligned with a portfolio or overall risk view, whereas US GAAP focuses on the individual components.
That's a very good way to put it. And the conditions for grouping differ too. For US GAAP fair value hedges of groups, for instance, each item in the group has to respond proportionally to the hedged risk.
They all have to move in sync.
Proportionally, yes. IFRS doesn't have that strict proportionality rule for groups. And US GAAP lacks specific guidance for cash flow hedges of groups where things don't move proportionally, while IFRS does address that.
So definitely sounds like more flexibility for group hedging under IFRS, especially with net positions and non-proportional items.
That's a fair summary. And the layer component for groups. Again, US GAAP limits that to the portfolio layer method for fair value hedges. IFRS is broader.
Okay. We've talked about what you can hedge. What about the tools, the hedging instruments?
Right. Generally, under both, derivatives measured at fair value through profit or loss, FVTPL, are your go-to hedging instrument.
Okay, derivatives. No surprise there.
But beyond that basic point, they diverge significantly, especially regarding non-derivatives.
How so? Can you use things that aren't derivatives?
Under US GAAP, it's very restricted. Generally, you can only use a non-derivative financial instrument to hedge foreign currency risk, and only in two cases: hedges of net investments in foreign ops and fair value hedges of firm commitments. That's basically it.
So for hedging interest rate risk or commodity risk under US GAAP, you're pretty much stuck with derivatives.
Almost certainly yes. IFRS, however, is much more open. Certain non-derivative financial assets or liabilities measured at FVTPL can potentially be used to hedge any type of risk, not just FX risk.
Whoa, that's a massive difference. Using a plain vanilla bond to hedge something other than FX. Possible under IFRS, but not GAAP.
In specific circumstances where the non-derivative is measured at FVTPL, yes, it's a major divergence.
Okay, what else about hedging instruments?
Both require you to designate either the whole instrument or a proportion. But IFRS lets you formally exclude certain components from the designation itself.
Exclude. Like what?
The time value of an option you bought, or the forward points in a forward contract, or foreign currency basis spreads. Under IFRS, you can carve these out of the designated hedging instrument.
Okay, and US GAAP?
US GAAP takes a different angle. It allows you to exclude certain components, similar things like time value or forward points, but you exclude them from the effectiveness assessment, not from the designation itself.
Subtle but different. IFRS says this bit isn't part of my hedge tool, while GAAP says the whole thing is my tool, but I'll ignore this bit when checking if it works.
That's a great way to capture the difference. Also, written options.
Selling options to hedge.
Yeah. US GAAP is stricter there. You generally need to show that the potential gain on your combined hedge position is at least equal to the potential loss. IFRS doesn't have that specific gain-loss test unless you're using the written option to offset a purchased one.
Okay. More hurdles for written options under GAAP.
And remember, US GAAP prohibits combining a derivative and a non-derivative into one single hedging instrument. IFRS might allow that in some cases.
Right. It really does seem IFRS offers more flexibility on the instrument side, what you can use and how you designate it.
Generally speaking, yes. Okay, let's move to a really critical piece. Hedge effectiveness. How do you know the hedge is actually working?
Right. You can't just declare it a hedge. You have to prove it's effective. What are the rules?
Both define effectiveness. Similarly, it's about how well the hedging instrument offsets the changes in the hedged item due to the hedged risk. But how you assess that differs.
Okay, IFRS first.
IFRS has three main requirements. One, there must be an economic relationship. Two, credit risk shouldn't dominate the value changes. Three, the hedge ratio used must be appropriate for the actual quantities being hedged.
Economic relationship, credit risk, hedge ratio. And the focus is mainly forward-looking,
Primarily perspective, yes.
looking forward. And US GAAP, how do they test effectiveness?
US GAAP requires the hedge to be expected to be highly effective. That's perspective. And actually have been highly effective. That's retrospective. Looking both ways.
Highly effective. Is that where the 80 to 125% rule comes in?
Exactly. While that specific range isn't written into the main standard, it's very widely used in practice as the benchmark for highly effective for both the forward look and the backward look.
So US GAAP has this common benchmark and looks both prospectively and retrospectively.
Correct. And US GAAP also has a shortcut method in limited cases, where if the critical terms match perfectly, you can assume perfect effectiveness without detailed calculations. IFRS doesn't really have that same shortcut provision.
Okay.
Yeah.
And how often do you have to check this effectiveness?
IFRS says at least at each reporting date, or if significant changes occur. US GAAP is more prescriptive, at least every 3 months.
Quarterly checks under GAAP, minimum.
Yep, regardless of whether it's an interim or annual report.
What about the methods? Do they tell you how to measure effectiveness? Regression analysis, dollar offset?
Neither standard mandates specific methods. Whether you use quantitative or qualitative methods is up to the company, but it needs to be documented up front.
Okay.
US GAAP does explicitly mention things like statistical methods, like regression or offset methods, and that critical terms match shortcut. IFRS is more principles-based. Use a method appropriate for the hedge.
Got it. Now, what if the hedge isn't perfect? There's some ineffectiveness.
Good question. Under US GAAP, if the hedge is still deemed highly effective, within that 80-125 range usually, any minor mismatch or ineffectiveness isn't separately calculated or reported in P&L.
So if it's effective enough, the whole change goes where it's supposed to go OCI for cash flow hedges.
Exactly. The entire effective portion's change goes to OCI for cash flow and net investment hedges under GAAP. IFRS handles it differently.
How so?
For cash flow and net investment hedges under IFRS, the ineffective portion is calculated, usually using an offset method on a cumulative basis, and that ineffective amount hits profit or loss immediately.
So IFRS directly measures and reports the slippage in the P&L.
Precisely. It singles out the ineffective piece. And IFRS also requires considering the time value of money, like using present values, when measuring ineffectiveness. US GAAP doesn't have that specific requirement as part of the ineffectiveness calculation itself.
Okay, now we talked about excluding components earlier, time value, forward points. How does that relate to ineffectiveness?
Right. Under IFRS, when you exclude those components from the designation, they're accounted for separately as a cost of hedging. They don't factor into the ineffectiveness calculation at all.
They're treated completely separately.
Yes. Under US GAAP, where you exclude them from the effectiveness assessment, their accounting treatment is handled differently.
How are those excluded bits accounted for then?
Under IFRS, it depends if the hedge relates to a specific transaction or a period of time. Transaction-related costs might get added to the cost of an asset bought or hit P&L when the hedged item does. Time period-related costs are usually amortized to P&L over the hedge's life.
Okay, a tailored approach in IFRS and US GAAP.
US GAAP generally offers two main ways to recognize the initial value of those excluded components in earnings. Either amortize it over the hedge instrument's life or use a mark-to-market approach where changes hit earnings currently. That IFRS distinction between transaction versus time period doesn't exist in GAAP.
So different ways to get those excluded costs into earnings under GAAP, but less linkage to the nature of the underlying hedge compared to IFRS.
That's a good summary. Now, what about credit risk? Surely that can mess up a hedge.
Yeah, if your counterparty looks shaky, how do the standards handle that?
Both require you to consider credit risk, both the counterparties and your own, when assessing effectiveness.
Okay, so it's on the radar for both.
Yes, but under IFRS, if credit risk becomes the dominant factor driving value changes, that can actually force you to stop hedge accounting.
Credit risk takes over, hedge accounting stops.
Pretty much. US GAAP generally ignores credit risk changes in the effectiveness test unless default is no longer probable. If default looks likely, that can also trigger discontinuation under GAAP, but day-to-day credit spread changes usually don't impact the effectiveness measure itself except for those shortcut hedges.
Okay, so GAAP seems a bit less sensitive to ongoing credit changes affecting the effectiveness math, unless it gets really serious.
Generally, yes. Now, what if your hedge ratio gets out of whack? You hedged 100 units, but now you only need to hedge 90. Can you adjust? That's rebalancing.
Balancing, tweaking the hedge amount.
Exactly. IFRS actually requires you to rebalance if the hedge ratio is no longer effective, but your original risk management objective for that hedge is still valid. You adjust the quantities and update the documents.
But IFRS wants you to fix it and carry on, if possible.
Yes. US GAAP doesn't have mandatory rebalancing like that. Generally, if you significantly modify the hedge terms, like the ratio, you have to de-designate the old hedge and potentially designate a new one.
A clean break under GAAP, usually.
More often than not, yes. There might be some limited exceptions for partial de-designation, but the default is often de-designate.
Different philosophies again. IFRS tries to preserve the relationship. GAAP prefers a fresh start for big changes.
That captures it well. Now, inevitably, hedges end. How do you handle discontinuation?
When do you have to stop applying hedge accounting?
Both agree on the basics. You stop if it no longer meets the qualifying criteria, if the hedging instrument expires or is terminated, or if that economic relationship breaks down.
Okay, the obvious reasons.
But here's a huge difference. IFRS prohibits voluntary discontinuation. If the hedge still qualifies, you must keep applying hedge accounting.
Wow, so even if you decide internally you don't want to manage it that way anymore, if it still works according to IFRS rules, you're stuck with the accounting.
You are. US GAAP, however, permits voluntary discontinuation. You can just decide to stop applying hedge accounting, even if it still technically qualifies.
That's a massive philosophical split. Freedom under GAAP, constraint under IFRS.
It is. And the accounting after discontinuation also differs. For fair value hedges, both stop adjusting the hedged item, and previous adjustments are amortized if the item is at amortized cost.
Okay.
For cash flow hedges, what happens to the amount built up in OCI depends on whether the hedged forecast transaction is still expected, IFRS, highly probable, or probable US GAAP to occur. The criteria differ slightly, affecting when that OCI amount gets recycled to P&L.
So the timing of hitting earnings could differ.
Yes. For net investment hedges, both generally keep the OCI balance related to currency translation until the foreign operation is sold.
Okay, that's consistent.
There are also differences in how those previously excluded components are treated after discontinuation, especially if the hedged item remains on the books.
It feels like the echoes of hedge accounting can linger differently under the two systems even after it stops.
That's a good way to put it. Now, quickly, central clearing of derivatives.
Becoming much more common. How does that affect hedges, like if your contract gets novated to a central counterparty, CCP?
IFRS has specific relief. If the novation to a CCP is required by law or regulation, and the changes are minimal, you don't have to stop hedge accounting.
Okay, a specific relief for regulatory-driven changes.
US GAAP is broader. It basically says a change in counterparty doesn't automatically kill the hedge accounting as long as other criteria are still met, regardless of why the counterparty changed.
So US GAAP is more flexible on counterparty changes in general, not just CCP novations.
Seems that way, yes. And both generally agree that just changing how variation margin is legally characterized doesn't force discontinuation.
Okay, now hedging within a corporate group, intercompany stuff. That sounds messy.
It can be. Under IFRS, internal derivatives between group companies are eliminated in consolidation, so they generally can't be hedging instruments in the consolidated financials.
Even if the group hedges the net risk externally.
Even then, US GAAP is different here. It can allow an internal FX derivative with another group member to be the hedging instrument in the consolidated statements, but only if that other member has an offsetting external derivative with an outside party plus other conditions.
Right, needs that external link under GAAP.
Yeah.
What about hedging intercompany loans or sales themselves?
IFRS allows hedging the FX risk on intercompany monetary items if they don't fully eliminate in consolidation. It also allows hedging highly probable forecast intercompany deals if the risk hits consolidated P&L.
Okay, and US GAAP.
More conditions. To hedge forecast intercompany transaction FX risk under GAAP, you need things like the hedging unit having the right functional currency and, again, often those offsetting external contracts.
Definitely feels like more hoops to jump through for intercompany hedging under US GAAP.
Generally, that's true. Okay, last big topic, interest rate benchmark reform, the whole IBOR transition.
Huge deal. How did accounting rules cope with that uncertainty?
Both IFRS and GAAP issued guidance. IFRS took a phased approach, Phase 1 and Phase 2 amendments, both mandatory. US GAAP's guidance wasn't phased and is optional for companies to apply.
Optional under GAAP. Interesting.
Yeah. Both provide relief or expedience to help companies avoid stopping hedge accounting just because of benchmark reform uncertainty, like changing the reference rate.
So they tried to smooth the path.
They did, but the specifics differ. IFRS Phase 1 gave temporary exceptions around things like the highly probable test and assessing the economic relationship. US GAAP offers optional expedients, often elected hedge by hedge, like allowing documentation updates, changing assessment methods, rebalancing, changing the benchmark rate used for hedging.
More choice under GAAP, it sounds like.
Potentially. US GAAP also had specific relief for discounting transition. The timelines for when this relief ends also differ. IFRS ties it more to when the uncertainty resolves. US GAAP set a general sunset date for many expedients, often end of 2024.
Okay. Disclosures.
IFRS had specific, quite detailed disclosure requirements for the reform phases. US GAAP generally required fewer additional disclosures.
And GAAP's reform guidance also hit other areas, like leases.
Yes, US GAAP's guidance also touched on contract modifications, general disclosures, and leases. IFRS Phase 1 was narrower, focused mainly on hedge accounting. Phase 2 of IFRS broadened out a bit more, dealing with ending Phase 1 relief, amending designations due to reform, handling OCI balances, group hedges, and non-contractual risk components, plus its own disclosures and effects on leases and some insurers.
Wow. So both provided help for the IBOR transition, but through different mechanisms, timelines, and scope.
Exactly, a complex overlay on an already complex topic.
Well, this has certainly been a deep dive. It's crystal clear that while IFRS 9 and US GAAP share the same basic goal for hedge accounting, aligning the books with risk management.
The paths they take to get there are often quite different.
Absolutely. We've seen differences in what you can hedge, what you can use to hedge, how you test effectiveness, rebalancing, stopping hedges, intercompany rules. The list goes on.
It really underscores the complexity here. These aren't just minor tweaks. They can lead to genuinely different accounting outcomes.
Which means for anyone looking at companies across borders or just trying to understand a company's risk management reporting, you absolutely have to know which set of rules, IFRS or US GAAP, is being applied.
You do, because a strategy that seems identical from a business perspective might look quite different in the financial statements depending on the accounting standard.
So that leaves us with a final thought for you, the listener. Considering all these divergences we've discussed, how might a company's choice between IFRS and US GAAP actually shape not just its reported profits or equity, but potentially even influence the risk management strategies it decides to pursue in the first place?
It's a fascinating question. Definitely food for thought and maybe a reason to dig into the specific standards if this affects your work.
Indeed. Thanks for joining us on this really illuminating deep dive.